Hi guys, welcome back to the channel. Today's topic is something that separates smart investors from the crowd: crypto fundamentals. You've probably heard people say things like, Bitcoin's supply is fixed, that token have good tokenomics, or this project's inflation rate is crazy. But what does that really mean? Because here's the truth. Most people in crypto buy coins every day, but very few actually understand how those tokens are created, distributed, and what drives their value. So in this masterclass, I'm going to explain crypto fundamentals like never before: simple, visual, and real. By the end, you'll be able to look at any project and instantly tell whether its tokenomics are solid or dangerous. Before we dive deep, let's start simple. What's the difference between a cryptocurrency and a token? A cryptocurrency is the native coin of a blockchain network. It's what keeps that entire system alive. For example, Bitcoin's cryptocurrency is BTC. Ethereum's cryptocurrency is ETH. These are like the fuel that power their respective blockchains. Now, blockchains like Ethereum, Solana, and BNB Chain also allow developers to create new assets on top of their networks. Those assets are called tokens. If you create a token using Ethereum ERC20 standard, it becomes an Ethereum-based token. Similarly, if you create one on Solana, it's a Solana token. Cryptocurrencies are the foundation coins that power their blockchains. Tokens are assets built on top of those blockchains. Cryptocurrencies mainly handle payments, mining rewards, or network security. Tokens, on the other hand, can serve almost any purpose: gaming, governance, or access to decentralized apps. So before investing in anything, always ask yourself, why does this token exist? What problem does it solve? That single question filters out 80% of hype projects. Now that we've cleared that up, let's talk about tokenomics, the backbone of every crypto project. Tokenomics defines how tokens are created, how they're distributed, and how they enter circulation over time. It's like a project's economic DNA. Everything is pre-coded: total supply, inflation rate, deflationary mechanisms like burns, and even reward systems. Once these rules are written into the smart contract, they're set in stone. And that's why supply design is one of the most important parts of tokenomics. Let's use Bitcoin as our perfect example. Bitcoin's total supply is fixed at 21 million coins. No one can ever print more. Every 4 years, the amount of new Bitcoin entering circulation gets cut in half, an event known as the Bitcoin Halving. What happens during a halving? New supply drops 50%. Inflation slows down. Scarcity increases. It's like a digital version of gold becoming rarer every 4 years. By 2040, every Bitcoin will have been mined. Right now, over 90% already exists. Currently, miners earn 625 BTC per block. After the next halving, that'll drop to 3.125 BTC. That's Bitcoin's built-in discipline. Its inflation doesn't just drop, it's mathematically programmed to disappear. Now here's something most people forget. Incentives are the heartbeat of crypto. Why do people mine Bitcoin? Why do validators run nodes? Why do liquidity providers lock their funds? Because they get rewarded in tokens. That's the genius of Web 3. In Web 2, companies keep all the profits. In Web 3, you share the network's success. But if a project prints too many tokens to reward people, inflation skyrockets and prices crash. So, good tokenomics always finds that sweet spot between incentives and scarcity. The 6 pillars of tokenomics. Let's break tokenomics into 6 clear parts. 1. Supply distribution. Who owns what? When a project launches, it divides its total tokens among the team, investors, and the community. If founders and investors together hold more than 50%, that's a red flag. And here's the pro tip: always check the vesting schedule. Good projects lock founder tokens for at least 5 years, and investor tokens for 3 years with a 12-month cliff, meaning no unlocks in the first year. If tokens unlock too soon, the risk of a dump is high. 2. Supply inflation. This shows how fast new tokens are released. Bitcoin's halving is the perfect model: slow, predictable, deflationary. But if a project releases tokens too quickly, it creates a flood effect: more supply, same demand, lower price. 3. Token utility. Ask, what can people actually do with this token? Is it used for governance, staking, payments, access? If a token's only use is speculation, it's a ticking time bomb. Utility equals longevity. 4. Value capture. Here's the money question. Does the project's success make the token more valuable? If a platform earns fees, do they? Buy back tokens, burn supply, or reward stakers? If yes, that's strong value capture. If not, the token might stagnate even if the project grows. 5. Business model. Every crypto project needs one. Ask, how does it sustain itself? Transaction fees, staking rewards, lending interest, these are all solid models. If the only plan is launch a token and hope it pumps, it's not good tokenomics. 6. Demand drivers. And finally, why will people want this token long term? Demand can come from staking, governance, rewards, or strong community use. The more reasons to hold, the stronger the price support. Let's put all that theory into a real-world example. Arbitrum project. Arbitrum's maximum supply is 10 billion tokens. At launch, only 1.27 billion were in circulation, and that stayed constant for nearly a year. Starting March 2024, new tokens began unlocking for the team and investors. By 2027, the full 10 billion will be in circulation. Here's the breakdown. Investors, 17.5 per team, DIO Treasury and airdrops, 42%. So around 44% is with insiders, still balanced enough for a large-scale ecosystem. And what's smart? They didn't flood the market. Their vesting schedule is 4 years long, predictable, fair, and community-friendly. That's what good tokenomics looks like in practice. How to research any project. So how can you check all this yourself? Just Google tokenomics of project name. Do that, and you'll always find blogs, dashboards, or data sources explaining it. All right, let's recap. Strong tokenomics come down to 6 things: supply distribution, inflation, utility, value capture, business model, and demand drivers. If a project gets these right, it's designed for long-term success. If not, it's just another pump and dump waiting to die. Remember, in crypto, numbers tell stories, and tokenomics is the language they speak. If you found this breakdown helpful, please share with others. Thanks for watching.